Welcome to our comprehensive guide on risk modeling in finance. In this video, we'll explore what risk modeling is, why it's essential, and how to implement it using various techniques. So, what exactly is risk modeling? At its core, risk modeling is the process of identifying and measuring risk using statistical models and simulations. The primary goal is to predict potential financial losses and make informed decisions to mitigate those risks. To kick things off, let's understand some types of risks you might come across. These include market risk, credit risk, operational risk, and liquidity risk. Market risk involves the possibility of losing money due to changes in market prices. Conversely, credit risk deals with the potential that a borrower will fail to meet obligations. Operational risk revolves around losses due to failures in internal processes, people, or systems. And finally, liquidity risk is the risk of not being able to buy or sell assets quickly enough to prevent or minimize loss. Now that we've outlined the types of risk, let's dive into some common risk modeling techniques. First up, we have value at risk, commonly known as VAR. This technique estimates the potential loss in value of a portfolio over a defined period for a given confidence interval. For instance, if we have a portfolio valued at $1 million, and we calculate a one-day VAR at a 95% confidence level to be $20,000, this means there's only a 5% chance the portfolio will lose more than $20,000 in a single day. Next, let's look at stress testing. This technique involves evaluating how a financial portfolio performs under extreme market conditions or hypothetical scenarios. For example, imagine a scenario where the stock market crashes by 30% and interest rates climb by 2%. Stress testing helps us understand the potential impact on the portfolio under such unprecedented conditions. Another essential technique is Monte Carlo simulation. This method uses random sampling and statistical modeling to estimate probable outcomes. Let's say we want to predict the future value of an investment. By simulating thousands of possible market scenarios, we can assess the range of potential outcomes and their probabilities. Beyond individual techniques, it's also crucial to integrate risk modeling into a comprehensive risk management framework. Effective risk management combines quantitative methods like VAR, stress testing, and Monte Carlo simulation with qualitative assessments such as expert judgment and scenario planning. An essential aspect of this framework is regularly updating your risk models to reflect changing market conditions and emerging risks. For example, during times of economic uncertainty, like a financial crisis, it's important to reassess your risk parameters to account for increased volatility and correlations among asset classes. Another fundamental practice in risk management is diversification. By spreading investments across various asset classes, sectors, or geographies, you can minimize the impact of any single adverse event. Imagine you have a portfolio that includes stocks, bonds, real estate, and commodities. If one asset class performs poorly, the others might still provide stability, thereby reducing overall risk. So, how do we continually improve our risk models? One way is by using backtesting. This method involves testing a predictive model on historical data to gauge its accuracy and reliability. For example, if you've created a model to predict stock prices, you would compare the model's past predictions to the actual historical prices to see how well it performs. Another way to refine your models is through sensitivity analysis. This involves altering one variable at a time to see how changes impact the outputs of your model. For instance, if your model predicts investment returns, you might vary interest rates to see how sensitive the returns are to changes in the rate. Lastly, let's address some common questions about risk modeling. Q1. Can risk modeling completely eliminate financial risks? No. Risk modeling can't eliminate risks entirely, but it helps in understanding, quantifying, and managing those risks more effectively. Q2. Which is better? Qualitative or quantitative risk modeling? Both have their strengths. Quantitative methods like VAR and Monte Carlo offer precise measurements, while qualitative assessments provide context and expert insight. Q3. How frequently should risk models be updated? Ideally, risk models should be reviewed and updated at least quarterly and more frequently during periods of high market volatility. Remember, risk modeling is a dynamic process that requires continuous learning, updating, and adjusting. With the right techniques and tools, you can effectively manage financial risks and make well-informed investment decisions. Thank you for watching. We hope you found this guide on risk modeling helpful. Don't forget to like, share, and subscribe for more financial tutorials.